Master SPY day trading options with these 13 game-changing techniques. Want to unlock the secrets to profitable SPY day trading? Whether you're just starting or you're a seasoned trader, knowing the right options to choose and the best strategies to use can make all the difference in your trading success. In this video, we're diving into 13 powerful SPY day trading options that can help you make smarter decisions in the market, maximize your profits, and minimize risks. In addition, you will learn the pros and cons of each. By understanding how each of these strategies works and knowing when to apply them, you can increase your chances of success. So, grab a notebook and get ready to discover new ways to approach SPY day trading like never before. Number 1. Buying call or put options. Buying long call or put options is one of the most basic strategies in options trading. This technique involves purchasing either a call option, which profits if the price of SPY rises, or a put option, which profits if the price of SPY falls. The goal is to capitalize on significant price movements in SPY, allowing traders to potentially make a large profit from small changes in the stock's price. A key feature of this strategy is the limited risk, as the most you can lose is the premium paid for the option. This method is ideal for traders who anticipate sharp price movements, but don't want to take on the full risk of buying the stock outright. It's particularly effective in volatile markets where price fluctuations are frequent. Pros: the potential for significant profits with limited risk makes this strategy appealing to traders who can accurately predict market movements. Cons: while the risk is limited to the premium paid, the time decay of options can erode the value of the contract if the anticipated movement doesn't happen quickly enough. Number 2. Selling covered calls. Selling covered calls involves owning a stock, or in this case, SPY options, and then selling a call option against that position. The goal is to generate additional income by collecting premiums from selling the call, while still holding the underlying asset. This strategy works best when the trader expects the price of SPY to stay relatively flat or increase slightly. The premium collected from selling the call provides some downside protection, making it a popular choice for conservative traders looking to boost returns on their holdings. It's an excellent strategy for generating income in a sideways or slowly rising market, where the price of SPY isn't expected to break out significantly. However, if SPY rises sharply, the trader's upside is capped at the strike price of the call. Pros: it generates consistent income and provides some downside protection through the premium collected. Cons: the trader's potential profit is limited by the strike price of the call, and there's a risk of losing out on substantial upside gains if SPY rallies significantly. Number 3. Iron Condor. The Iron Condor strategy involves using 4 different options positions to profit from low volatility in SPY. It consists of selling a lower strike put, buying an even lower strike put, selling a higher strike call, and buying an even higher strike call. The goal is to profit from SPY trading within a defined range, collecting premiums from both the put and call spreads. Traders use this strategy when they believe SPY will remain within a specific price range during the option's life. The Iron Condor benefits from time decay, as the options sold lose value faster than those bought. If SPY stays within the range, the trader keeps the premiums as profit. However, if SPY moves sharply in either direction, the trader faces potential losses. Pros: it's a great strategy for markets that are expected to remain stable or range-bound, and it can offer high profitability in low volatility environments. Cons: if SPY breaks out of the range significantly, the trader can face substantial losses. So tight risk management is crucial. Number 4. Straddle strategy. The straddle strategy involves purchasing both a call and a put option at the same strike price and expiration date. This strategy is ideal when a trader expects significant volatility in SPY, but is uncertain about the direction of the price movement. The idea is that if SPY moves sharply in either direction, the profit from one of the options will outweigh the loss from the other. The straddle can be particularly profitable during earnings announcements, economic reports, or other events that may trigger large price swings. Since both options are purchased, the cost can be high, which is why it's critical to see a large price movement to offset the initial investment. The key to success is accurately predicting volatility and timing the market correctly. Pros: the straddle profits from large price movements in either direction, making it ideal for unpredictable events. Cons: the strategy can be costly due to the purchase of 2 options, and if SPY doesn't experience enough volatility, both options may expire worthless. Number 5. Strangle strategy. The strangle strategy is similar to the straddle, but with a key difference. The call and put options have different strike prices. The idea is still to profit from significant price movement in SPY, but the strangle allows traders to set the options further out of the money, reducing the initial cost. This means a smaller movement in SPY is needed to make a profit compared to the straddle, but the potential profit is also capped. Strangles are typically used when a trader expects volatility, but wants to minimize the premium paid for the options. While the strangle has a lower cost than a straddle, it still requires a significant move in SPY to break even. The key to success is identifying catalysts that can trigger large price movements. Pros: lower cost compared to a straddle, making it more accessible for traders with smaller budgets. Cons: still requires a big move in SPY to generate profit, and the profit potential is capped by the strike prices chosen. If you're enjoying this breakdown of SPY options so far, hit that subscribe button and don't forget to like the video. Stay tuned for more trading insights, strategies, and tips that will help you take your day trading game to the next level. Number 6. Bull put spread. A bull put spread involves selling a put option at a higher strike price and buying another put option at a lower strike price. This strategy profits when SPY stays above the strike price of the sold put, allowing both options to expire worthless. The bull put spread is a type of credit spread, meaning the trader collects a premium when entering the trade. The goal is to capitalize on a slight rise in SPY or a neutral to bullish market outlook. The premium collected from selling the higher strike put can offset the cost of buying the lower strike put, reducing the overall risk. This strategy limits both potential profits and losses, making it a more conservative option compared to buying calls or puts outright. Pros: limited risk and limited reward, which can be beneficial for traders with a neutral to mildly bullish outlook on SPY. Cons: the reward is capped by the difference between the two strike prices, and if SPY falls significantly, losses are incurred. Number 7. Bear call spread. The bear call spread is the opposite of the bull put spread, involving selling a call option at a lower strike price and buying another call at a higher strike price. This strategy profits when SPY stays below the strike price of the sold call. It's used when a trader has a bearish to neutral outlook on SPY and expects the price to stay below the strike price. Like the bull put spread, it's a credit spread that allows the trader to collect a premium. The risk is limited to the difference between the two strike prices minus the premium collected. The bear call spread is ideal for markets with neutral to bearish sentiment, but can be risky if SPY moves higher than expected. Pros: provides income potential with limited risk and is great for slightly bearish market conditions. Cons: if SPY rises above the strike price, the potential loss is substantial, so careful monitoring is required. Number 8. Calendar spreads. A calendar spread, also known as a time spread, involves buying and selling options of the same type, call or put, but with different expiration dates. The strategy profits from time decay, as the options with shorter expiration dates lose value faster than those with longer expiration dates. Traders use this strategy when they expect minimal price movement in SPY, focusing on capturing the difference in time decay between the two options. Calendar spreads work best in markets with low volatility, where price movement is slow and steady. The risk is limited, and the profit potential increases as the shorter-term options lose value. However, if SPY experiences significant movement, the strategy can result in losses. Pros: the strategy benefits from time decay and works well in low volatility environments. Cons: significant price movement in SPY can lead to losses, and the strategy requires careful timing and management. Number 9. Vertical spreads. Vertical spreads involve buying and selling options of the same type, either calls or puts, but at different strike prices. The strategy profits when the price of SPY moves in the direction of the bought option. Vertical spreads are popular for their ability to limit both risk and reward, as the price difference between the two strike prices defines both the maximum profit and loss. Traders use this strategy when they have a strong directional bias in SPY, whether bullish or bearish. Vertical spreads are ideal for moderate price movements, and the time decay of the sold option works in the trader's favor. Pros: limited risk and reward, making it suitable for traders looking for a controlled strategy. Cons: the potential for profits is limited, and if SPY doesn't move enough in the predicted direction, the strategy may not be profitable. Number 10. Butterfly spread. The butterfly spread is a neutral strategy involving 3 strike prices: buying 1 call at a lower strike, selling 2 calls at a middle strike, and buying 1 call at a higher strike. This strategy profits when SPY stays close to the middle strike price at expiration. The idea is to capture the time decay on the 2 short options while minimizing risk with the long options. It's a great strategy for traders who expect little to no movement in SPY, as it has a limited risk and limited profit potential. While the maximum loss is defined by the net premium paid, the maximum profit occurs if SPY closes exactly at the middle strike price. Butterfly spreads are ideal for low volatility environments, but can lead to losses if SPY moves significantly in either direction. Pros: limited risk and the potential for high returns if SPY closes near the middle strike price. Cons: the price movement of SPY must be minimal. Significant movement in either direction results in losses. Number 11. Diagonal spread. The diagonal spread is a combination of a calendar spread and a vertical spread. In this strategy, a trader buys an option with a longer expiration date and a different strike price, while simultaneously selling an option with a shorter expiration date and a different strike price. This strategy is useful for traders who expect moderate price movement and want to benefit from both time decay and directional movement. The diagonal spread provides flexibility, allowing traders to profit from the price movement in SPY, as well as the time decay of the sold option. This strategy is often used when a trader has a slight bullish or bearish outlook on SPY. However, the risk can be higher than simpler strategies like vertical spreads, due to the two different expiration dates and strike prices. Pros: allows traders to capitalize on both time decay and directional movement, with the potential for profits from both. Cons: more complex than other strategies and involves higher risk due to the combination of different expiration dates and strike prices. Number 12. Gamma scalping. Gamma scalping is an advanced strategy that involves actively managing options positions to profit from small price movements in SPY. The goal of gamma scalping is to maintain a delta-neutral position, meaning the position is adjusted as SPY moves to ensure minimal directional bias. This strategy works by continuously adjusting the position as SPY moves, buying or selling options to lock in profits from small price changes. Gamma scalping is highly active and requires constant monitoring of SPY's price and the options position. The strategy profits from small fluctuations in price, taking advantage of rapid price changes while reducing the exposure to market movements. While this strategy can generate profits in volatile markets, it also requires significant skill and attention to detail to execute effectively. Pros: can generate profits from small price fluctuations and volatility in SPY. Cons: requires constant monitoring and quick adjustments, making it time-consuming and complex to execute. Number 13. Long call or put butterfly spread. The long call or put butterfly spread is similar to the standard butterfly spread, but is based on calls or puts at the same expiration and strikes, where the trader uses either all calls or all puts in the strategy. This strategy profits when SPY stays near the middle strike price at expiration and the price moves within a tight range. The long call or put butterfly spread offers a limited risk and limited reward, making it a great strategy for low volatility markets. The maximum profit occurs when SPY closes at the middle strike price, and the trader can keep the full premium collected from the options. Although the risk is limited, significant movement in SPY away from the middle strike results in losses, so careful timing is essential. Pros: limited risk and the potential for significant rewards if SPY closes at the middle strike price. Cons: works only in low volatility markets and requires precise timing, as significant movement in SPY can result in losses. Now that you know the 13 game-changing techniques for SPY day trading options, it's time to put them into action. Whether you're looking for big moves, stable income, or a way to manage risk, these strategies can help you navigate the market like a pro. If you found this video helpful, don't forget to hit that like button and subscribe for more trading tips and strategies that will boost your options trading game. Drop a comment below and let us know which strategy you're most excited to try out.